Welcome back to Evolve TV, where we look at the fascinating tales behind some of the world's most intriguing companies. Today, we are going to look at the rollercoaster path of Zomato, the massive meal delivery company that reached amazing heights but also encountered enormous difficulties. Get ready for an exciting journey through the highs and lows of Zomato's history, and uncover the vital lessons that any entrepreneur may take away. The concept of food delivery is not new in India. The Dabawala meal delivery system emerged in Mumbai about 125 years ago, during British rule, to cater to the city's growing population of workers. This system relied on delivery men known as Dabawalas. In 2012, three friends, Ralph, Rohit Chadda, and Ben, founded Foodpanda, which revolutionized online food delivery. Foodpanda was once worth $3 billion, with operations in 45 countries and over 200,000 food orders delivered each day. However, this once proud company eventually became a cautionary tale about how food delivery businesses can fail. Foodpanda, valued at over 21,000 crore rupees, was acquired by Ola in 2017 for only 250 crore rupees.
Cab-hailing app Ola is all set to enter the food delivery space. The company has acquired Foodpanda's India business. Ola is committed to invest $200 million.
Ola invested 500 crore rupees to revive the business, but losses continued to mount, leading to the suspension of Foodpanda's food delivery operations in 2019. So, the online food delivery industry has a history of financial difficulties. The real question now is whether history will repeat itself with Zomato. To better understand this, let us consider Zomato's business model. Founded in 2008 by Deepinder Goyal and Pankaj Chatta, Zomato started as a restaurant discovery platform in India. The founders identified a need in the market for trustworthy restaurant information and reviews. They seized this opportunity, quickly scaling their platform and expanding into food delivery services in 25 countries, including the United States, India, Australia, Brazil, New Zealand, Singapore, and the Middle East, Qatar. On July 21, 2021, Zomato debuted on the Indian stock market. Despite the fact that the company was losing money, it was marketed to retail investors as a promising investment opportunity. Incredibly, Zomato's stock price more than doubled within the first 3 months of its listing. By November 16, 2021, it had reached an all-time high of 169 rupees, representing a return of more than 220% on its initial price of 76. Retail investors were ecstatic, believing they were making easy money with Zomato. However, this excitement quickly turned into a nightmare as the stock began to crash. So, the big question is Zomato going bankrupt? This Indian startup is delivering an impressive 4,000 food orders per minute. Their revenue is skyrocketing daily, but this growth is accompanied by significant losses. These losses are so substantial that they could potentially lead to bankruptcy. Because of this, some might suspect Zomato is a valuation scam. However, there's still a chance for Zomato to become the next Amazon of India. Curious to know how? Let's dive into it in this video. Moving ahead, let's break down how Zomato makes its money. You might be thinking it's just from delivering food, but there's a lot more to it. Zomato now generates 7 major revenue streams. The first one involves restaurant listing and advertising. This was one of Zomato's first revenue streams, and it still plays an important role today. It's like paying for a prime spot in a busy market. Zomato also provides local advertising for restaurants on its network, similar to Google. The second category is shipping fees. Zomato takes delivery fees from users and gets a percentage from restaurants that process the orders. The commission is then split between Zomato and the delivery person. Loyalty programs serve as the third source of income. Zomato offers a variety of loyalty programs that provide members with exclusive benefits. The fourth source is ticket sales for special events. Zomato sells tickets for festivals and events such as Valentine's Day and New Year's. They receive a commission on these sales, which they collect from restaurant owners in exchange for attracting customers to their events. Each event is marketed through the Zomato app, which generates additional advertising money. The fifth option is Zomaland, a food and entertainment festival. Zomaland combines top eateries, musicians, DJs, comedians, interactive exhibits, and carnival activities to provide an offline version of Zomato's selected collections. Sixth, Zomato has become a smart advisor to restaurants, using their data to help restaurants improve their business. Eateries now seek Zomato's advisory services due to their huge data on eateries and consumer behavior. Zomato offers advice on demand levels in specific areas and competition, using their large database and analytical tools. They also offer white-label services to assist food organizations in developing tailored delivery apps, which generate income. The seventh source is a big deal because it's a win-win situation. They're into delivering fresh ingredients to restaurants to help them make better food, and better food means more orders on Zomato, and restaurants are happy to pay for this extra help. This way, Zomato assists restaurants in making their supply chains more efficient and predictable, as well as enhancing the overall quality of the food they offer. So, as you can see, Zomato is not just about delivering your food. They're building a whole food ecosystem. Now let's take a look at the issues Zomato faces. There are two big challenges that they face. First off, people are super picky about food delivery apps. With so many choices out there, it's easy for customers to jump ship for a better deal. In 2021, Swiggy and Zomato shared roughly 13% of the same user base, showing how customers switch between services for better deals. Customer loyalty is a big issue because people tend to follow discounts. They compare prices on Swiggy and Zomato and choose whoever offers the best deal. To tackle this, Zomato tried to lock people in with special memberships like Zomato Gold and Zomato Plus, but that didn't work out so well. The second difficulty for Zomato is its increasing losses. Since becoming public, Zomato has made initiatives to reduce its losses. One significant move was exiting from 4 countries: the US, UK, Singapore, and Lebanon. Zomato struggled to capture market share in developed economies like the US and UK, marking a major setback. Normally, acquisitions help companies expand, but Zomato's approach has been questionable. Acquiring Fitso, which focuses on healthcare rather than food, raised eyebrows, which is like buying apples when you sell oranges. Because of such decisions, it is very evident that Zomato has not been smart regarding decisions around allocating capital, and when it comes to capital allocation, Zomato was expected to set an example for other startups planning to list in the stock market, but instead Zomato became an example of what exactly not to do while allocating capital. Recently, Zomato acquired Blinkit for approximately 4,447 crore rupees to enter the quick commerce market. This acquisition is risky for 2 reasons. Blinkit is a loss-making startup. Although the firm's average order value is about 509 rupees, which is 28% higher than Zomato, but Blinkit is still losing 84 rupees per order. So it is very challenging for Zomato to make Blinkit profitable, which is a risky bet because Zomato itself is a cash-burning and a loss-making company. And the second reason which makes this acquisition very risky is huge investment in Blinkit. Regarding the acquisition of Blinkit, Kotak Institutional Equity has stated that Zomato may require investments in excess of $400 million due to fierce competition. Players such as Dunzo, backed by Reliance, and Super Daily, backed by Swiggy, are well-funded and active in acquiring customers through discounts. With such significant expenditures in Blinkit, Zomato now faces the problem of surviving in the fast-paced commerce business while burning cash. Zomato's profitability remains unknown. The experiences of 2021 and 2022 have not persuaded investors or experts that significant changes are imminent. Challenges in the food delivery industry will not go away overnight, especially with increased competition in rapid commerce. Uber Eats' withdrawal from India highlights the difficulties, leaving only Swiggy and Zomato. The winner will most likely be the one who achieves profitability while outlasting the other in terms of capital burn. Some claim that both businesses have wealthy supporters, guaranteeing long price wars. Competition may increase if Swiggy and Zomato agree to lower cash burn rates, as this could attract new competitors. In the midst of these difficulties, concerns regarding Zomato's valuation surface. Its stock market valuation raises questions even though it is thought to be fairly valued in private equity. It is essential to comprehend the differences in values between different markets. If you've watched Shark Tank India, you might recognize Anupam Mittal, the founder of Shaadi.com. He's an active angel investor who has backed over 200 startups, including early successes like Ola and Rapido. Despite the fact that around 90% of startups in India fail within 5 years, Mittal's strategy is to make numerous investments, knowing that even if most fail, the remaining 10% could bring substantial returns. Venture capitalists and angel investors frequently fund a large number of businesses in the hopes that the few successes will overcome the failures. This approach leads to high valuations for loss-making startups in the private equity market. In contrast, the stock market values companies based on their profits, cash flow, price-to-earnings ratio, and growth potential. Zomato, still a startup, faces high risk today but also holds the potential for significant rewards in the future, like Amazon. Amazon's early years are similar to Zomato's present state as a losing venture that prioritizes client acquisition. Many investors, including Warren Buffett, were doubtful of Amazon's prospects when it went public. But as Amazon's growth history demonstrates, early doubt is not always a reliable indicator of future success. At Berkshire Hathaway's 2019 annual meeting, Warren Buffett declared, "I was wrong on Google and too dumb to appreciate Amazon." Years ago, Warren Buffett acknowledged that it was a mistake not to invest in Amazon. He acknowledged missing Amazon's potential because the company operated at a loss for 14 years. However, in 2001, Amazon achieved its first profit, changing perceptions and highlighting its potential value. Now, the question is whether Zomato can follow a similar path and become the next Amazon of India, and what Zomato can do next to become the next Amazon of India. So, the first thing Zomato should do is eliminate competition, as Amazon did by providing a unique consumer experience that no other e-commerce competitor could match. Zomato can accomplish the same thing by providing something unique that its competitors cannot. And in the future, Zomato can reduce competition by acquiring Swiggy, its sole competitor in the meal delivery market. However, Swiggy may wind up buying Zomato. Second, generating profitability is critical for Zomato, particularly after going public and obtaining large cash. Investors have been keen to see returns, rendering prolonged losses unsustainable in the long run. Zomato cannot keep making losses forever, so Zomato has to find a way to become profitable by improving its business model and changing its business approach to become profitable. Thirdly, diversification into new promising sectors is key. Amazon's success with AWS demonstrates the effectiveness of diversification. Zomato already has multiple revenue streams beyond food delivery, but the company is working on more diversification plans to help it become more successful and reliable. But before we end this video, check out our Evolve executive summary and learnings from this case study. So the key takeaways from this video are: 1. Concentrate on customer-centric innovation. One of the most important takeaways from Zomato's success is the value of customer-centric innovation. Zomato realized early on that in order to succeed in a competitive landscape, they needed to properly understand and adapt to its customers. 2. Try to diversify your business. Zomato's story also teaches the need of diversifying revenue streams. Beyond food delivery, Zomato has expanded into advertising, events, and even hyper-pure initiatives. This diversity not only reduces risks but also opens up new options for revenue growth. 3. Failures are the pillars of success. It's important to always learn from our failures. Zomato's experiences with unsuccessful ventures, like subscription models, emphasize the importance of learning from its mistakes. It demonstrates the need for adaptability and the capacity to adapt strategy based on market feedback. 4. Maintain a long-term vision with persistence, and constantly consider the best version of something. Zomato's story, like Amazon's early years, emphasizes the significance of perseverance and long-term thinking. Building a successful business takes time, and overcoming obstacles is critical to long-term success. In conclusion, Zomato's business presents both risks and promises. It could either follow in the footsteps of failed companies like Foodpanda, becoming a case study in the challenges of the food delivery industry, or it could succeed in the long term, proving its critics wrong just as Amazon did with Warren Buffett. The future holds both uncertainties and potential for Zomato. That's it for today, guys. If you have learned something new from the video, then do like the video, as this will make the YouTube algorithm happy, which will help this video to reach as many people as possible. And don't forget to subscribe to the channel to watch more insightful case studies, and also comment on your favorite part or learnings from this video. Thank you for watching. This is your host signing off. We will meet in the next video. Till then, stay awesome, stay focused, keep learning and keep growing. Peace out.